Why financial crises always end richer for the same institutions? Every financial crisis is sold to the public as a catastrophe. Jobs vanish, savings evaporate, governments plead poverty. Ordinary people are told to tighten their belts, accept austerity, and rebuild responsibly. Yet here is the mystery no one addresses. Why do the same institutions that fuel these crises always emerge wealthier, larger, and more powerful than before? If crises are failures, why do the biggest banks survive every single one? If markets punish bad decisions, why are the worst decision makers rewarded? And if governments claim to act in the public interest, why does the public always pay while financial institutions collect? This is not an accident. This is not bad luck. And this pattern did not begin in this 2008. Today, we follow the money from the origins of modern finance to the present, to understand why financial crises don't destroy power. Concentrate it and watch till end, to understand why crises enrich the same institutions. We must first understand how the modern financial system is built. At its core, modern finance is not about money. It is about credit creation. Banks do not simply lend existing money. They create money through debt. Every loan expands the money supply, and every repayment contracts it. This system is overseen by central banks, backed by governments, and stabilized in theory by regulation. But here's the twist. The institutions responsible for risk-taking are structurally protected from the consequences of failure. Governments depend on banks to finance deficits. Central banks depend on banks to transmit monetary policy. Pension funds, insurance companies, and markets depend on banks for liquidity. So when banks fail, they don't fall alone, they threaten the entire system. This is where the story begins to repeat. Every major financial crisis starts the same way. Cheap money meets aggressive leverage, interest rates are lowered, credit expands rapidly. Asset prices rise, risk appears to vanish, banks lend more, investors borrow more. Asset prices inflate beyond fundamentals. This happened in the 1920s, before the Great Depression. It happened in the 1980s, during the savings and loan crisis. It happened in the 1990s, during the Asian financial crisis. And it happened spectacularly in 2008. But the seeds of crisis are invisible at first, because rising prices disguise instability. Debt creates growth until it creates fragility. During the boom phase, financial institutions do not behave cautiously. They increase leverage, meaning they borrow heavily to amplify returns. They securitize risk, packaging debt and selling it to others, extract fees, commissions, and bonuses, regardless of long-term outcomes. Here is the critical asymmetry. Profits are private, losses are social. Executives are paid during expansion. Shareholders benefit from rising prices. Risk is pushed outward to households, pension funds, governments. By the time instability becomes visible, the wealth has already been extracted. Eventually something breaks. Interest rates rise, asset prices stop climbing, defaults increase, liquidity disappears. Confidence collapses faster than it was built. In 2008, it was subprime mortgages. In 2020, it was global shutdowns. In emerging markets, it is often currency collapse. The cause is always the same. Too much debt stacked on fragile assumptions. When the system reaches this point, governments face a dilemma: let the banks fail and risk total economic collapse, or rescue them and confirm that failure has no penalty. History shows which choice is always made. Bailouts are never presented as bailouts. They are called emergency liquidity, stabilization measures, quantitative easing, temporary support, but the outcome is identical. Central banks inject trillions into financial markets. Governments guarantee losses. Interest rates are slashed to near zero. Asset prices recover quickly. Stock markets rebound. Real estate stabilizes. Meanwhile, wages stagnate. Inflation erodes. Savings taxes rise. Public services shrink. The cost is not paid up front. It is spread across decades. After every crisis, there are promises. Stronger regulation, more oversight, limits on leverage, protection for consumers. And every time, these reforms fade. Why? Because financial institutions are not just economic actors, they are political ones. They fund governments. They advise regulators. They employ policymakers after retirement. Reform threatens the very mechanisms governments rely on to function. So the system is adjusted, not transformed, and the cycle resumes. Look at recent history. After 2008, major banks became larger, not smaller. Market concentration increased. Inequality widened dramatically during COVID. Trillions were injected into markets. Asset owners benefited first. Small businesses disappeared permanently today. Debt levels are higher than ever. Central banks are trapped between inflation and collapse. The same institutions control more capital than at any point in history. The crisis didn't end the system, it reinforced it. Because financial crises are not system failures, they are system functions. They eliminate competitors, consolidate power, transfer assets downward to those with liquidity, reset political resistance. Those closest to money creation survive. Those farthest from it absorb the shock. This is not conspiracy. It is structural design. Financial crises are predictable, not accidental. They arise from debt-based systems that reward risk without accountability. Bailouts are wealth transfers, not rescues. They move resources from labor and taxpayers to asset holders. Power concentrates fastest during instability. Crises are moments of redistribution. The real danger is not the next crisis. The danger is that each crisis leaves fewer institutions, more concentrated power, and less room to recover. At some point, the system stops absorbing shock and starts amplifying it. When that happens, bailouts will no longer be enough. If this video changed how you see financial crises, share it with someone who still believes these collapses are accidental. Subscribe if you want more deep, serious breakdowns of power, money, and systems. Thanks for watching.